Chris Langstaff, our head of research and strategy for Canada, the author of our latest ISA briefing on the impact of residential mortgage rate increases. Chris, these resets that are coming in residential mortgages is one of the factors that we're watching in the Canadian economy. So tell me about how these work in Canada. How do residential mortgages work, and what are we looking at?
Okay, so in Canada, there are really two types of residential mortgage loans. A fixed rate loan, which is the bulk of the mortgage loans in Canada, and variable rate loans. Fixed rate is about 68% of the Canadian mortgage market, and variable rates are about 33%. And with an environment of rising interest rates in the last year or so, there's been a lot of talk of the impact that has on consumer balance sheets, on the broader economy, the impact of GDP, and so forth. But to understand it and to compare it across countries, you really have to dig into the numbers. First of all, the bulk of them, I said, is fixed rate. And the way that works in Canada is you have a mortgage that amortizes over usually 25 or 30 years. Within that period of time, you have a term, a fixed rate term, usually of 5 years. And during that time, the mortgage is set at the interest rate at which is prevalent at the time, and that lasts for 5 years. Your payments are fixed, your interest proportion is fixed. If you have a variable rate mortgage, you still have a fixed payment, but the proportion of interest within that payment moves based on the prevailing interest rate. So as interest rates have moved up, people are paying more interest and less principal. There are cases where the interest rates have gone up high enough that the interest payment actually exceeds their total payment. That excess gets added to the total mortgage, and it takes longer than the amortization period to pay off the entire loan. But the bulk of the market in Canada, when we dug into the numbers, shows that actually those numbers are very small. First of all, only 36% of Canadians have a mortgage. And then, as I said, within that, only 33% of that have a variable rate mortgage. So most people who have fixed mortgages, and the bulk of those do not expire for 3, 4, 5 years from now, you're looking at a time period where likely interest rates may come down again and there's less risk to the economy.
So that's the situation in Canada. Chris, you spent some time with colleagues looking at what are the exposures in other countries, and how does the Canadian situation with mortgage rate resets compare to that in other countries? What did you find?
The most interesting comparison, I think, is our neighbor to the south, the United States, where the bulk of residential mortgages there are 30-year terms. And so the risk of kind of reset and what have you is very low. We looked at some data from Fitch Ratings, and they were looking at mortgage rate resets over the next 24 months. So say into 24, 25. And it found that the markets that had the greatest exposure, the greatest risk, in order, were Australia, Spain, the UK, and then Canada. The US was like dead last. They were very, very, very low, less than 1%. Whereas in Australia, it was certainly a higher proportion. It was more like 92.5% that are rolling in the next couple of years. So it depends on what market you're in. That's going to impact how it's going to play out depending on what country you're in.
So for investors in institutional real estate, such as LaSalle and its clients, which is not usually investing directly in for-sale residential, why do these mortgage resets matter, and why is that something that we should be tracking?
It's important to keep an eye on the residential housing market because it does, in most countries, comprise a sizable proportion of the economy. To the degree that people's consumer spending is more heavily weighted towards housing, it's quite likely that that's going to impact other spending in their household. So they're going to perhaps cut back on retail sales. They're going to cut back on discretionary spending if more of their income is being geared to a mortgage payment, for example. So there are knock-on effects on the broader economy if there is any kind of weakness in the housing market. What we've seen in Canada, just as an example, though, is that because house prices have become more expensive, it's pushed more people into the rental housing market. 41% of households in Canada rent, and that's been growing with high immigration. And so that has been fueling demand for multifamily, which currently is at a 20-year low vacancy rate in this country. And that's certainly been happening in other countries around the world as well. The other sector that it does impact, particularly in the US and other countries that have it, is the single family housing rental sector, which has grown in prominence in that country for sure. It's not a big piece of the Canadian market, if at all, but other countries where it exists, that's obviously been that sector has been benefiting from, call it a more expensive or higher interest rate environment in the housing market.
Right. So some risks to monitor to the economy and consumer spending, disposable income, but also perhaps a bit of a silver lining in terms of substitution of demand from ownership housing into rental housing, which should have some benefit to fundamentals.
Yes,
so Chris, thanks for joining me today. Appreciate talking through the recent note. If you want to read more, you can see that on LaSalle.com, along with our third quarter 2023 LaSalle Macro Quarterly, which looks at this question and macro generally with a series of slides. So please have a look at that, and thanks for listening today.
Thank you.